Have you ever had that feeling? You know the one. You see the perfect trade, you click buy right at $50, but somehow your order fills at $50.12. You just shrug, right? Chalk it up to bad luck, market craziness. But what if it's not luck at all? What if it's the whole point? Let's dig in.
So that feeling you get, that suspicion that the market zigs just when you zag, it's not in your head. You're not being paranoid. This isn't some wild conspiracy theory. It's a very real, very systematic process. And the amount of money we're talking about here, it's just staggering. We're looking at over $20 billion being quietly skimmed from investors like you and me every single year, all through these tiny, almost invisible little price gaps. This, my friends, is the millisecond heist. So is this all just the cost of doing business? The unavoidable friction of a fast-moving market? Or is the game itself designed to create these tiny losses for you and guaranteed profits for someone else? That's the question we're going to answer. And our story really starts with one guy, a trader who just couldn't let it go. He was a major player at a huge bank, but every single day he felt like something was deeply, fundamentally wrong with the markets he was trading in. Meet Brad Katsuyama. Back around 2007, he was a top trader for the Royal Bank of Canada. He'd click his mouse to buy, say, 10,000 shares of a stock at a certain price, and by the time his order went through, poof, maybe 2,000 shares were left. The rest had just vanished in the blink of an eye. At first, he thought, man, am I just getting slow? But he started keeping a log, documenting every single trade. And this really disturbing pattern started to emerge. This wasn't random. In fact, the bigger his order, the worse it got. It felt surgical, like someone knew exactly what he was doing the moment he did it. This wasn't just bad luck anymore. It felt like theft. And then he had his aha moment. The US stock market. It's not one place, like the New York Stock Exchange you see in movies. It's a fragmented web of over a dozen public exchanges and a bunch of private ones called dark pools. His orders were hitting the closest exchange first, and someone was using that tiny microscopic head start to race him to all the other exchanges. You see, this race wasn't about being a smarter trader or a better analyst. It was about being a faster one. It was about weaponizing the actual laws of physics, the speed of light, to create a nearly risk-free profit machine. The weapon in this war is something called latency. It's just a fancy word for the time delay it takes for information, like your buy order, to travel through a fiber optic cable. To you and me, a click feels instant. But in these markets, that instant is an eternity filled with millions of dollars of opportunity for anyone who can move just a little bit faster. Okay, so here's exactly how the heist works. Step 1, your order to buy a stock hits the nearest exchange. Let's call it Exchange A. Step 2, a high-frequency trading firm, an HFT firm, sees it. Their algorithm instantly knows what you're trying to do. Step 3, they raise ahead of your order, literally faster than your data can travel, and they buy up all the shares on exchanges B, C, and D. And step 4, milliseconds later, when your order finally arrives, the shares are gone. But don't worry, that same HFT firm is happy to sell them to you now, just at a slightly higher price. I mean, just think about the difference in risk here. When you invest, you're taking on market risk, right? You're betting you're right about a company's future. The HFT firm, they take on virtually zero market risk. They couldn't care less if the company succeeds or fails. They're just betting on physics. For them, it's a near certainty. So just how valuable is this speed advantage? Well, firms went to absolutely incredible lengths to get it. One company, Spread Networks, spent $300 million to build a brand new fiber optic cable in a perfectly straight line from Chicago to New Jersey. And what did that $300 million project get them? They shaved just 4 milliseconds off the travel time. That is less time than it takes for a bee to flap its wing once. But that tiny, tiny sliver of time was a license to print money, and it proves just how much cash was being pulled out of the market. So Brad Katsuyama is watching this insane technological arms race, and he realizes you can't win by trying to get faster. The game is rigged. So he came up with this totally radical, completely counterintuitive idea. What if you could make a market fair by intentionally making it slower? And that's exactly what he did. He and his team, they left their cushy, high-paying jobs to build their very own stock exchange from scratch. They called it IEX, the Investors Exchange. And its entire mission was to create a leveled playing field, a place where speed couldn't be used as a weapon against you.
Their solution was so elegantly simple. They created what they call a speed bump. It's literally 38 miles of fiber optic cable coiled up inside a box. Every single order that comes into their exchange has to travel through that entire coil, delaying it by just 350 microseconds. That's just enough time to make sure nobody can see an order coming and race ahead of it. It neuters the predators. Now, you might be thinking, okay, this is fascinating Wall Street drama, but I'm just trading on my phone. How does this really affect me? Well, the mechanism that brings this heist directly into your pocket is probably something you think is a great deal. It's called payment for order flow, or PFOF. See, when you use a commission-free broker, they often aren't sending your trade to a public exchange to fight for the best possible price. Instead, they're selling your order directly to a massive high-frequency trading firm. Which, leads us to that classic question. If you're not paying for the product, you probably aren't the customer. In the world of free trading, your order flow is the product being sold, and the high-frequency trading firms, well, they're the real customers.
So here's how the money moves. 1. You place your free trade. 2. Your broker sells that order to a firm like Citadel or Virtue. 3. You get your shares at a price that seems okay, but it might be a fraction of a penny worse than what was actually available. 4. That tiny fraction of a penny is pure profit, which the HFT firm and your broker then split. Now, multiply that by millions and millions of trades every single day.
Look, this whole system is designed to be confusing and opaque. That's on purpose. But just understanding how it works, well, that's the crucial first step toward protecting yourself and demanding a market that's actually fair. So what can you actually do about it? A few things, actually. You can look for brokers that don't sell your order flow, even if that means paying a tiny commission. Always use limit orders. They set the max price you're willing to pay. Never use market orders. If your broker lets you, you can route your trades directly to fair exchanges like IEX. And honestly, the most important thing? Ask your broker tough questions and share this knowledge with other people. This systematic skimming of wealth only works because it's hidden in the shadows, buried in microseconds and complexity. It thrives in darkness. Now that you've seen how the millisecond heist actually works, the question is, what are you going to do with the light?